From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, inflation shows signs of cooling, the latest data being promising. And Powell on hold, saying the Fed is awaiting more evidence before cutting. Yet investors move on, keeping bets for at least one rate cut this year. But we begin with the big issue. Can the Fed achieve nirvana?
The U.S. economy is chugging along pretty well.
We've had good, healthy markets for quite a while.
There's 1,000 things that can go wrong tomorrow, but right now everything's in pretty good shape.
I think the chance of something going wrong is higher than people think.
It's necessary to make sure that we're on a fiscally sustainable path. Of course, the higher interest rate path makes that more difficult.
Where it'll be in 6 months, how much of that slowdown we see in the bottom quartile, we have to watch the data very, very carefully.
Whatever the world is pricing in for a soft landing, I think it's probably half that.
Right now we have a no landing, honestly, a 2% growth rate, because you can't say it's a soft landing.
The cost of living in many areas is very high, and it is a concern to Americans.
There are a lot of inflationary forces in front of us that, may keep it a little bit higher than people expect.
What the Fed is doing with rate structure is having the impact they want. On the other hand, the economy's kind of there, and now we got to be careful we don't overshoot the other way.
I think, they are doing the right thing to be patient right now.
Now let's look at the U.S. inflation picture, because a measure of underlying U.S. inflation cooled in April for the first time in 6 months, and it also snapped a streak of 3 above forecast readings, with the year-over-year measure cooling to the slowest pace in 3 years. Now, you do see progress here, but remember, we are still above the Fed's 2% target, and we also had producer price indexes that were on the rise as well. So complicated story there when you look at inflation. Let's flip up the board here and look at one component of inflation, the housing and rent part of CPI. Shelter prices is the largest category within services, and it climbed 0.4% for a third month. And owner's equivalent rent, a subset of shelter, which is the biggest individual component of the CPI, rose by a similar amount. And these housing costs are one part of the inflation picture staying so sticky in the Americas and abroad. Now, one big debate on Wall Street now is whether cutting interest rates will actually bring down some of these housing and rental costs. We'll talk about that later in the show. Meanwhile, BlackRock's Rick Rieder argues that the best way for the Fed to temper inflation will actually be to lower interest rates, and here's why he thinks that.
I'm not certain that raising interest rates actually brings down inflation. In fact, I would lay out an argument that if you cut interest rates, you'd bring down inflation. Why is that? Exactly to your point. Look at what's happening now. Interest expense is growing, has now eclipsed mortgage payments. Lower income, who much higher percentage of their net worth is in the debt, credit cards, student loans, auto finance, et cetera. What's happened is you've raised the rate, and that has created a real impact. And so, but the other side of it is you actually have an economy, because of this massive transfer from the public sector, from the government to the private sector. People at higher income, middle to higher income, are now getting a big benefit from these interest rates. And that's flowing into, those are the people that spend in aggregate on services. So there's an ironic thing that I've never seen, nobody's ever seen in history.
Joining us now is Allspring's George Bory and Al-Hussainy of Columbia Threadneedle. And when you take a look at a lot of this wishful thinking on Wall Street, this hoping that we will finally see at least one rate cut, you see the reaction in yields very significantly. The 2-year holding the line at 480 by the end of this week, after just being above 5% just a couple weeks ago. Do we keep holding the line?
I think so. I mean, look, I think the case for the Fed to at least start this normalization process this year is getting stronger. The labor market is seeing a lot less churn. Some of the dynamism is leaking out. The inflation story is maybe about 50 basis points away from when this process can start. And more importantly, when you look at next year, I think the case for normalizing rates is getting stronger, and that's what the 2-year yield is trying to capture at the moment.
We were talking a little bit, George, about the sticky inflation story here. And do you worry that housing or other parts of inflation won't come down fast enough to achieve that first rate cut?
That's a great point. And it is fair to say that, inflation's kind of It's sort of stalling out is probably the best way to define it. It's not going up, which is good from the Fed's perspective, but it is, the strong downtrend is yet to really be truly affirmed. So our expectation is stickyflation continues. It will come down over time, but it comes down at a very, very slow pace, and it's unlikely to get all the way down to sort of the Fed's target without some economic weakness behind that. And so, the economy is doing pretty well, as many of the commentators you mentioned or you highlighted leading up to the segment, identified. And the reality is the economy is doing pretty well, that the Fed doesn't really need to move. At least they don't need to move rates overall. But we would just highlight the fact that they did moderate the pace of quantitative tightening. And so, this sort of slow incremental move towards a slightly easier policy, you could argue has started. The data would need to confirm that, but the expectation for an actual rate hike, we think is clear, is much further out, and is really at best close to the end of the year.
I like the word you used here, George, stickyflation. Ed, how do you see stickyflation playing out here?
Let me point to two elements, two components of inflation. There is a cyclical element which responds to demand, and there are elements that are acyclical or sticky that are the ghosts of inflation past. They're a function of the dislocation to the economy 2 or 3 years ago. Most of the inflation we see today is the ghost of inflation past, which is really important. And that's, we're talking about auto insurance, homeowners insurance, housing rents. Those are all functions of the dislocations we saw in 2020 and 2021. The good news is that the cyclical pickup in the economy that we're seeing, the economy is growing at about 3% in terms of underlying demand, hasn't translated into new inflation. And that's fantastic news for the Fed.
So, George, I want to ask you a question that I had just asked Ed. Do we hold the line at 4.8% here? What's the risk here that rates don't move materially higher on the short end, given the tremendous bid we have seen at the short end of the curve in the bond market?
Yeah, no, I think that also is a very good point. I think you're talking about the 2-year part of the curve. Yes. So I think that there's a good case to be made that you have good sort of carry that the Fed is stuck at the very least on hold for an extended period of time. So the 2-year, not a terrible spot to be. And that on balance, the bias would be to cut rates rather than hike rates. So from that perspective, that there is some argument to be made that there's some value there. I think 2.8 or 4.80 is very much right in the middle of the range. We are certainly happy to kind of put money to work right in and around the 2-year. Certainly, if we were going to add some credit risk in portfolios, that adds a little bit of extra yield to the portfolio. So it's not a bad spot. We would feel pretty comfortable in and around that 2-year point on the curve.
Where else on the curve? Ed, are you looking further out at this point, given you've seen such an investor move into those long ends, and they do have more uncertainties and other factors that would influence the price moves there?
Yeah, I mean, I think I would agree with the other speaker. The front end of the curve is still pretty attractive, and we're trying to build confidence to extend our duration out, right? The fact that the Fed's reaction function, the Fed strategy at the moment is really biased towards easing. The fact that we're starting to see, again, churn in the labor market start to come down. The labor market on the margin is showing us some flags of weakness. These are all really great precursors to moving duration further out on the curve.
How do you feel about duration now, George? Do you think that there's just too much risk to get in the further you get out?
Our central message, the Allspring central message around duration is diversify duration. There are attractive spots along the curve. We take it all the way out to the 5-year. We just look at pure value, anywhere between the 2 out to the 5-year part of the curve is where we're trying to establish kind of long core or long duration positions. That being said, there's different types of duration. Long end kind of corporate credit, particularly on the high quality side, it has been a great spot to sort of allocate money. Or in the intermediate part of the curve, mortgages have had a little bit of a lumpy ride in the first half of the year, but sort of sticking with that trade as volatility comes down could be attractive. So our main message is don't get too wed to just one specific point on the curve. Diversify. Make sure that that duration is aligned with the type of risk that's inherent that you want to be sort of aligned with your portfolio. And from that perspective, the curve is fairly flat. So you can take some duration extension risk, and it doesn't really cost you all that much from a give up. If it's a funded position, it can get expensive because it becomes negative carry. But depending on how you run your portfolio, there are different ways to position position duration.
So don't lever up on a 10-year position.
Not yet.
Really what you're saying here. Ed, what about the yield curve inversion here? Because it's interesting. You look at where we are today. You have a lot of happy talk in the market right now, and you do still have a 210 curve that is inverted to really the worst levels we've seen in the last 7 weeks. How do you read that?
Yeah, I mean, I think it's consistent with the fact that we saw a surge of inflation come through in the first quarter. Some of that is now starting to dissipate. It's consistent with markets expecting the Fed to bring rates down over the next couple of years. And it's also consistent with longer end rates now being a little bit higher than they were pre the COVID shock. The disinversion process can be driven in a couple of different ways. Classically, the Fed cuts very aggressively in the face of a recession. The odds of that are increasing the more the Fed stays on hold. We also have brief periods when the curve inverts, when long end rates go up. Fiscal risk premium is a really key catalyst for that. At the moment, I'd say, where do you place your chips? It is likely that the curve will disinvert. I don't think this year is the right time frame, perhaps at some point next year, but we do need to see more weakness in the economy to drive it. And until we see that weakness, the front end is going to yield much better.
Long time for those steepeners to play out. Our thanks to George Bory and Ed Al-Hussainy for joining us today. Now up next, the auction block. Johnson & Johnson becomes the latest blue chip firm to seize on thriving debt markets, driving the U.S. high-grade sales nearly past $700 billion. Details ahead. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where global issuance remains strong. We're going to start in Europe. Weekly sales were near 70 billion euros, making it the third busiest week of 2024. It included Merck, which sold the region's longest dated corporate bond in the common currency since 2021, and it sold more than 3 billion euros over 4 parts, including a 30-year. And here in the U.S., blue chip names like J&J, Goldman, Ford, and McDonald's sold debt this week. Overall, there were more than $28 billion worth of sales, driving the yearly total to nearly $720 billion. And also of note, business development companies are getting in on the borrowing spree. The Morgan Stanley Direct Lending Fund and Blue Owl Credit, both with sales this week. BDCs invest in small and mid-sized firms, typically too risky or small for the banks. And speaking of credit, Goldman's Christina Minnis remains positive.
Credit has been a very good place, and people have made very good money in credit. And while there is concerns about volatility, there's actually a lot to be kind of constructive about. We have a reasonably strong economy. People's earnings are reasonably strong. And so it actually feels like a good time to be investing in credit. Things actually look decent. And again, when we look at the forward calendar, it's very manageable. And people have cash. When you just look at inflows into high yield funds and loan funds from this time last year to today, we're up 19 and 16 billion. So there's a lot of money that's flown into credit.
And joining us now is Matt Mish, head of credit strategy at UBS, and Maureen O'Connor, global head of high-grade debt syndicate at Wells Fargo. And Maureen, giving you the first word here because of this issuance calendar just running red hot. How does that continue on as you see the year going forward?
Yeah, I mean, I think, listen, we've had an extremely robust demand environment since the start of the year, which has really driven spreads down to what are 2-year tights and in some places cycle tights and investment grade. So naturally, companies are taking advantage of strong market conditions and pre-funding some of their upcoming maturities. You saw a lot of M&A supply in the first quarter as well. You had banks rushing to market to fund at ultra-tight spreads. We do expect some moderation in the calendar going forward. Some of that is just seasonal. First half of the year tends to be about 60% of our total volume. Second half tends to average about 40%. But we are in an election year. That can sometimes influence behavior. I think ultimately it will be the economics of the trade as we get closer to the election as to whether or not you see borrowers moving forward in that window. But I think there is some anxiety around volatility on the go forward. So while we aren't expecting to end the year up 33%, which is where we are right now from an issuance perspective, we are expecting a good 10 to 15% over and above last year's volume. So it still should be, pretty active new issue calendar here going forward.
Definitely keep it coming. Matt, what's interesting here is that you definitely see very strong demand for investment grade issuers. You have also seen incredible demand for much weaker borrowers as well. For some in the market, it's a very healthy sign of strong demand. For others, there's a lot of worries about the risk being taken on at these rates. How do you feel?
Yeah, look, I think, the demand picture remains firm. I think even less so on the fund and mutual fund side, really, spending a lot of time globally with clients in the last few weeks. It's really foreign demand. It's yield buyers, places like Europe and Asia, demand coming just because the absolute yield is attractive. In general, we've written recently, there are, I would say, a few signs that are starting to suggest that higher for longer is starting to bite, but it's very, very early stages. I'd point to SME or private firm bankruptcy filings picking up. Leveraged loan default rates have picked up over the last 2 or 3 months. But overall, the picture, I would say, is relatively constructive. We think you're setting up for a slowdown in growth. But there's very few signs, I would say, that we're entering more of a sinister downturn or recessionary type conditions, and very limited, I would say, on aggregate, very limited deterioration in credit fundamentals.
It's so funny because you see certain parts of the market that are even choosing at this point between debt and equity raises. What is the investor psychology here, Maureen, in terms of who's getting into what at this point?
Yeah, well, at least as far as credit markets are concerned, we're seeing cash come in from all different angles. So Matt mentioned some of the fund flows that he's seeing on the mutual fund side. Definitely true in the high grade asset class as well. We're up about 40% in terms of inflows into ETFs and mutual funds in 2024 versus last year. But we're also consistently seeing a very deep bid from our liability-driven investor base. So that's pension funds, insurance companies, folks that are attracted to elevated yields. The index is sitting at 5.5% for investment grade. That is usually an entry point that has been attractive in the past. It's an entry point that's made investors money. And it's ultimately the level of yields that's what's keeping spreads at these ultra-tight valuations. But we also have foreign demand for our asset class. That will wax and wane with the cost to hedge dollars. But I think at the end of the day, fixed income and credit specifically has been such a rock solid place to stay invested and to pick up some incremental yield in an environment where, while growth is slowing, is still very strong. So from our perspective, we see spreads in investment grade being pretty range bound here in the near term.
Yeah, I want to talk more about that in a second here, because Matt, you do hear a lot of investors complaining about not being compensated necessarily, at least when it comes to spreads, even if you're getting the yield. When you see spreads, investment grade, high yield, so tight, do you think that they are right to be pouring in at this set of valuations?
Well, I think it depends on the asset class. But if you take high yield, for example, we generally are looking for default rates to increase about 50 basis points, but to just about 1.5% for the full year. That's still several percentage points below the average. And so, you could justify what optically looks like a tight spread around about 300 basis points. I think, every market, as you get, we would say, mid to late cycle, and you have to get a little more selective in credit selection. Every market's different, but overall, the answer, I would say, is fundamentally, you can justify, the aggregate level of spreads, I think, to a large extent. I do think things are at the tighter end, but we would agree with Maureen. I think you will stay here. The two biggest risks in the market, I think one was allayed at the margin earlier this week, which is another Fed hiking cycle. The second one, which, we've seen the weakness in data surprises, the second one would be a mild recession. But we think those two are fairly remote possibilities. Outside of that, I think the market, again, fundamentally looks like it's holding up. And technically, there's just a lot of strength and resilience at these higher yields.
So if we do stay range bound, What is the trading theory here when you're thinking about how investors are planning to get into this market, given that you say that there's kind of a window here?
Yeah, well, I think in your last segment, you heard a lot about diversification, and I think that probably still holds here. I think the trade that most investors are looking at just in terms of alpha generation for 2024 kind of sits in two different pockets. One is continued compression across the rating spectrum. So, you're seeing triple Bs compressed down to what are now, multi-year tights to single As. There's still probably a little bit of room to run there. Obviously, double B spreads to triple B spreads have also compressed to near decades tights. So beta compression is very real. You're seeing that up and down the capital stack as well. So borrowers able to access sub-debt, junior sub-debt, preferred shares at premiums over their senior levels that are the tightest we've seen in a cycle. So you're definitely seeing investors get more comfortable reaching down the credit spectrum, down the capital stack to pick up more yield. I think that is a trade that will continue to get focused this year. And then also the compression between financials and corporates. There's still some value in that trade as well, especially when you look at where bank spreads trade relative to higher quality corporate names. There's still about a 25 basis point differential in the 5-year part of the curve for a lot of those names. So there's probably some room for further compression there. And I think that's where investors are kind of focusing their attention right now in the near term, especially as we move into this perfect soft landing scenario.
Matt, you have 20 seconds here. Favorite trade?
I would say in investment grade, we like the 3 to 5 year part of the curve, and we like financials, so we like compression. In high yield, we've taken off high beta, so triple C risk, but double and single B. We like areas that we think benefit from lower rates and lower inflation. Those would be areas like non-cyclicals and tech. And then just lastly, we really like Europe versus the US. So you can express that in Yankee banks. You can look at subordinated debt and tier 2 or AT1. But those would be 3 quick ideas from our side.
Matt, Maureen, thank you so much for your time. That is Matt Mish of UBS and Maureen O'Connor of Wells Fargo. Now, still ahead, the final spread, the week ahead, Fed minutes, NVIDIA earnings, and more. We will talk all about it. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up Monday, the Atlanta Fed kicking off its financial markets conference. Of course, we will have our own Michael McKee there speaking to Raphael Bostic and Loretta Mester. And of course, the health of the consumer will be in focus with Macy's and Lowe's earnings on Tuesday and PMIs on Thursday. Keep an eye, a lot of news ahead. But for us, that does it for now. Same time, same place, Real Yield next week. This is Bloomberg.